We are delighted to have Cathy Schrand as our main speaker, who will have 50 minutes.
I'm going to talk about earnings quality, and pretty much any talk on earnings quality or article about earnings quality starts with some statement like the following. There's no agreed upon definition of earnings quality. But I actually don't agree with that. I think that Baruch Lev established for us the definition of earnings quality that's still considered to be a definition that we use today in his paper from 1989, which I'll refer to as the R-squareds are low paper on the earnings returns relation. And he never came out and actually said, I define earnings quality to be anything. But he made statements such as the following. No serious attempt is being made to question the quality of earnings prior to correlating them with returns. And he proposed a research agenda for what we should do to better understand the quality that would relate earnings to returns. And in so doing, he effectively defined earnings quality as that characteristic or feature of earnings that makes them useful to equity markets. And so I think there is a definition. The problem is that what we really mean to say is that earnings quality is unobservable. We can't write down a definition easily for what we mean by it, but I think we can all agree in principle about what earnings quality is. So recognizing that earnings quality is an unobservable variable suggests to me that we should use an approach from the latent variable literature on unobservable constructs to assess the literature that we have, the research that we have about earnings quality, to understand whether we really understand the concept earnings quality, what we know about it, and to see where the research might go in order to better understand earnings quality. So I'm going to go all the way back to 1955 and Cronbach and Meal's nomological network, which was their approach for understanding a latent construct. And in fact, they said that scientifically speaking, what we define a construct as, its definition comes from understanding the network of connections in which this construct exists. That's the basic idea, kind of like Jeff's elephant yesterday, that we can understand the elephant if we understand all the parts. And what this suggests about what the research should look like is that in the early history there will be this limited network of connections between the construct and other constructs. And that research should try to establish these connections, but there needn't be any theory involved. There can just simply be descriptive evidence about the connections between observable measures or traits that we think might be associated with this construct and other constructs. But as the research proceeds, the network sends out more and more routes, and we then start to better understand the construct. So in terms of earnings quality, I would suggest that the network looks something like this. We have a lot of variables that I'm going to call exogenous, such as the accounting rules, the nature of the firm's operations. We have some other exogenous factors like how much earnings management occurs, how much estimation there might be. We have some features of the firm that might affect earnings quality, such as corporate governance or auditors. We have some incentives of the agents who are producing the earnings numbers that we might want to consider, enforcement of the rules. All of these things would affect the earnings quality number that we might observe, or the earnings number that we might observe, and hence its quality. And we have different proxies that we use for earnings quality, observable measures that we assert might be associated with quality, such as characteristics of the earnings series itself, how persistent it is. We might have outcomes that we think might be associated with high or low quality earnings, such as SEC actions. We might have characteristics of earnings that we assert as researchers would affect earnings quality in theory, like we think earnings that are managed are less reliable. And then we try to establish connections between all of these factors and these proxies. And in so doing, we define our earnings quality construct. And on the other side, we then have the consequences of quality. This is another branch of the network that we could define. And again, in specifying and understanding these connections between earnings quality proxies and our equity market variables, we then gain a better understanding of this latent construct. So that's what the net might look like. And what do I conclude based on looking at the earnings quality research in this net? First, I would conclude that we're generally following exactly the kinds of research paths that Cronbach and Meal in 1955 said one would follow if they were trying to establish construct validity of a latent variable. We have too much of certain types of research and too little of others, and the bulk of my talk will be on specific genres of research where we've done too much or too little given the nature of this particular latent variable. My second conclusion, though, is that we have not well aggregated all of the connections in this net in order to really understand the latent construct earnings quality. Now, this is where I'm going to poke a little fun at Peter about his distinction between young and old faculty. When I talked to him about what I was supposed to do today, I inferred the following, that my extra 40 minutes that I have relative to Jake and Ray is because I can't just assert something like this. I don't have that credibility as a senior faculty. So I'm going to have to prove this to you. And I decided the best way to do that was to actually appeal to some other senior people. So, I'll come back to this. So what I'd like to do is question whether it really is a bad thing that we haven't yet gone through the process of aggregating these various independent pieces of research which establish connections in our network to figure out whether we really have a valid construct or which construct might be a valid construct for earnings quality. So is it really bad that we haven't done this step in the research of establishing construct validity? And I would say that yes, it is if you believe that other disciplines are doing things right. The problem of latent variable analysis is not unique to accounting. If you think about marketing, they're trying to establish construct validity of terms like satisfaction. The OB literature looks at terms like strategy. The MIS literature looks at terms like user involvement, all of which have the same latent or unobservability characteristic to them. And yet their literature goes back to the 1970s and 80s on the importance of establishing construct validity, the aggregating the individual pieces of the net to really understand what it is we're measuring. Is it really bad that we're doing this? Yes, it is. Even if you don't believe that getting a measure of earnings quality, a single construct that we think can measure that latent variable, is important, that is, even if you don't believe we want something like a quality score, it's important because understanding construct validity and having valid constructs is part of the entire scientific research cycle. If we want to do tests of theories about why quality might matter or what might determine quality, we need to understand the validity of the constructs we're using to measure quality in those theory-based analyses as well. And Straub, I think, so I'm appealing to an expert here, put this best, saying that besides just being part of construct validity analysis and that being a goal in and of itself, it permits follow-up research to use a better instrument and improves the power of our tests where we might have a more economic focus or theory-based focus. And finally, is this really bad? Well, maybe we do want an earnings quality score, and it makes sense to have one summary measure or one construct that we think can measure earnings quality. And again, I'm going to appeal to some quotes, so bear with me. The first one is from the strategy literature. The idea that strategy, a term much like earnings quality, was new in the management field. This was 1979. And that they do feel a definition is needed, that careless and imprecise use of this term should be avoided. From the marketing literature, we have a statement that more stupefying than the sheer number of measures and the ease with which they are proposed is the uncritical manner in which they are accepted. And more generally about scientific research in general, not marketing or any business discipline, Peter in 1979 said that valid measurement is a sine qua non of science, that a discipline is not even a science if it doesn't go through this process of validating its constructs. And my favorite is from Thomas Schelling in Micromotives and Macro Behavior, where he says that a hastily chosen term in a language, this is about the development of language in general, gets imitated into the language before anybody even notices what an inappropriate term it is. And in collective laziness, this term becomes carelessly used and ceases to communicate with accuracy. And I think earnings quality is one of those terms. I don't agree with Jeff that we should vote it off the island, because I think we still do need this concept of earnings quality. No matter what we call it, this concept exists, and what we should do, I think, is make sure that our research doesn't become carelessly used, that we go through the statistically rigorous process of validating our constructs for this term so that practitioners or whoever uses this term understand what it really means. Now, I don't want to talk too much about the methods of actually establishing construct validity. One, I don't view myself as a particular expert in that area, but two, the methods that one would use to aggregate the connections in the net and establish construct validity are specific to the traits or characteristics or instruments that you're trying to validate. But I will provide some general characteristics of the types of tests that I'm thinking of. The first two bullet points sort of go together, that one would use statistical analysis to evaluate multiple proxies or indicators or traits. And each of the indicators or traits would be measured by multiple types of methods. The purpose of the test is to establish both convergent validity and discriminant validity, where convergent validity in a broad sense implies that the proxy that you're trying to establish validity of is correlated with other things you think should be measuring the same thing, and it's not as correlated with other proxies that you don't think should be measuring the same thing. Now, one example of this is the multi-trait, multi-method matrix of Campbell and Fisk, if that sort of conjures up the kind of test that I'm thinking about. And again, I don't want to go through the methods in detail, but the point is that all of these methods, statistical methods that are available, are attempting to establish both convergent and discriminant validity at the same time for the same set of measures, measured by the same researcher on the same data, so that you can really get a statistically rigorous measure of whether your proxy is in fact measuring what you think it should be measuring. Now, methodological studies of this type are currently virtually non-existent with respect to earnings quality, or with respect to virtually anything in the accounting literature for that matter. But there are some recent papers that take as their goal measuring construct validity. The kinds of tests that they use are not necessarily the multi-trait, multi-method sorts of tests from the psychology literature, but the goal is, in fact, to establish construct validity. And a final point I want to make about this is both of these papers are 2006. I think this is the right trend that we're going toward. and that this isn't a one-paper solution that I'm suggesting, that we write one paper on construct validity, do factor analysis, and we're done. We've identified the right construct. This is an entire area of research where papers like the Ecker et al. And Wysocki paper would be part of the whole research agenda to eventually establish construct validity. I'm not going to say anything more about construct validity and the need for that part of the research cycle, because as I said, there's virtually no research on that. The rest of the talk, I'd like to focus more on the actual network that we've developed, and using the framework from the psychology literature, make statements about the relative importance of certain parts of the literature that we have developed and parts of the literature that I view as underdeveloped. So I'm going to start with the left-hand side of the network as I had originally diagrammed it, which I'll call the determinants of quality connections. Those exogenous and sometimes endogenous factors that we assert determine the quality of earnings. And the first comment that I'd like to make about that is that we've established an incredible amount of positive evidence about what the determinants of quality are, but not so much the negative evidence, which is important in terms of establishing validity of a latent variable. And here's an example. There are two papers, Latent, and Barbanel and Boucher, that both find negative evidence with respect to accounts receivable. And actually, let me take a break at this point and have the same caveat that the previous authors did about citing literature. I don't mean this to be a literature review, and in fact, I chose the papers to cite because I was hoping that I can just put up the name and the date and you all recognize them, and I don't need to describe the papers any further. And they describe a full genre of literature, and it will conjure up in your mind exactly what I mean by just citing a few papers. So Latent, and Barbanel and Boucher both find what I would call negative evidence with respect to accounts receivable. One finds an insignificant relation where they thought there should be a significant, and one finds, in fact, the opposite sign of what they expected to find with respect to this signal of earnings quality. Both go on to investigate their negative evidence within their paper. For example, in the Latent paper, doing contextual analysis based on the inflation during the period. And both are careful about stating within their own paper their conclusions. Barbanel and Boucher, in fact, talk about some of the signals, raise doubts about their ability to predict earnings. So the papers don't in any way hide these negative findings or overlook them. And they do contextual analysis to try to explain them within the paper. But accounts receivable is just one of 9 or one of 11 signals that they're examining within this paper. The point really is that since then there's been virtually no follow-up on this result, despite the fact that accounts receivable is one of the more significant determinants of cross-sectional variation in accruals. There's been no direct examination from what I could find of this negative evidence in the mainstream academic literature. And it's basically ignored in studies of total accrual or discretionary accruals in large sample studies. So even though we know this negative signal is out there, we haven't further investigated it, and we haven't even taken it into consideration in our research that involves accruals. Second point, and again, this is probably the most extensive part of the network, is how important is it anyway? And Cronbach and Meehl would say that these sorts of criterion-based tests where we assert a particular criterion like persistence or whether there's been an SEC action are most appropriate when there's consensus about the construct of interest. And in order to illustrate this point, let me give you some examples of when these criterion-based tests of the determinants would be most useful for establishing construct validity. The first example one extreme of a latent variable is bankruptcy risk. It's latent variable. We don't know exactly how to measure this risk. But Altman measures it using the following definition. It's the firms in his sample that filed a bankruptcy petition, Chapter 10 of the National Bankruptcy Act. While we don't actually know what bankruptcy risk is, I think this is an example where we have a reliable measure. We can look and see if they actually did file a petition, code them a 1 or a 0. We can put it on the left-hand side of this analysis, and everybody's sort of in agreement that that's an outcome that would ex post reflect some ex ante risk. At the other extreme is the classic example from the psychology literature, which is intelligence. What do you put on the left-hand side? A good vocabulary, just knowing a lot of general information, how you express your ideas. All of these things could be indicators of intelligence. And even if we could agree that a good vocabulary is an indicator of intelligence and the best indicator, how would we measure that? How many words that you know, or a certain type of word that you know? So there's not much consensus about the construct here. And I would argue that earnings quality lies somewhere in between that. We have some guidance from the accounting standards about what we think a high-quality number should be. It should be informative about the amount, timing, and uncertainty of cash flows, about the economic resources of the firm, about firm financial performance. And we know from the field of finance what kinds of things equity holders should be concerned about. But even these concepts like amounts, timing, and uncertainty of cash flows and economic resources are themselves latent variables that are difficult to measure, difficult to specify, and the measurement of them will vary by researcher. The point again is that when you have a construct like earnings quality where there's not much consensus, then understanding the determinants of that proxy that you're measuring isn't really as important to the overall understanding of the latent construct as developing other parts of the net. So what about the second part of the net? The second part of the net is the consequences of quality, where earnings quality is taken as a given and then associated with some sort of equity outcomes, like returns or other dimensions of the pricing function in the equity markets. My first comment on the literature in this part of the network is that earnings quality is really a link in the chain between fundamentals and the equity market reactions. It's not the start of the chain, although it's viewed as such in many of the studies. And establishing separate connections between fundamentals, like a particular accounting rule, and persistence, and then establishing a connection between persistence and returns is not enough to make any conclusions about how a particular accounting rule affects returns. There needs to be a path by which fundamentals affect earnings quality, and that same earnings quality proxy that you're using then maps into returns. And there was some evidence, and there were some papers that tried, it seemed, to go down this path early on where they linked fundamentals to some particular dimension that they asserted was associated with quality, and then for that same sample, for that same fundamental, tried to link the outcome earnings quality to returns. But it's a relatively underdeveloped part of the literature, and it didn't get very far. Bernard and Stober have a quote that may explain why, that understanding the security price reactions to the release of cash flow and accruals data in their particular setting is too highly contextual to be modeled parsimoniously. And in the extreme, what they're saying is, if you really want to understand this relationship, by the time you get down to a powerful enough test of where you can actually find a relationship, you're doing a case study of a particular firm, and how its fundamentals map into its returns. Now, we can debate philosophically whether we have any comparative advantage as academic researchers to do those sorts of case studies. But the point that I would like to make today is that it doesn't really matter who does it. Even if equity analysts do it, it's an integral part of the net in order to understand earnings quality. And as academics, we should be aware of this more firm-specific sorts of analyses, these more contextual analyses that are being done even outside of academia in order to better interpret our evidence in large sample statistical studies. My next comment on this part of the network is that we've really concentrated just on returns as the output or the consequence, equity market consequence of earnings. There hasn't been, in my opinion, enough research on the information risk associated with having low quality earnings. So if low quality is interpreted as more risky in terms of the investor's ability to understand the firm, then that also will have implications for equity market prices and for equity market other measures of equity market consequences such as spreads or costs of capital. Now, some recent papers are looking more at this information risk idea associated with low quality earnings, but again, these are 2005 papers and papers that are forthcoming. This is a relatively undeveloped part of the literature, or underdeveloped part of the literature, where I think we can extend our knowledge of earnings quality by extending the research in this area. And the research in this area, just like the research that associated earnings with returns, can be extended with the same sorts of contextual analysis. When does low quality earnings, which creates information risk, actually produce the consequences? It's not just a single relationship. There are going to be contexts in which it does more or less. My final point on this area of the network is that we're lagging a little bit, I think, in terms of our use of technology. There have been significant advancements in, or enhancements to, anyway, asset pricing models, including behavioral type models. And it's not, but these advancements haven't really been brought into the accounting literature. We still just use abnormal returns taken from a basic market model and assert that this is the return that we want to look at, and haven't thought about the implications of the findings from these other asset pricing tests and how they might allow us to design more powerful tests of earnings quality. We have models developed over mostly the last 20 years that talk more about characteristics and prices and returns like volume, depth, and spreads, and how information is going to affect all of these dimensions of equity market variables. And yet we haven't incorporated, again, enough into our literature the predictions from these models and how we can use that to better assess earnings quality. And there are much richer data sets available with high-frequency data and data other than returns that, again, we haven't really exploited those data sets enough in the earnings quality literature. The first diagram that I put up had the determinants of quality and the consequences of quality. That was my diagram of the network. The next 2 points I'd like to make are things that I think are missing from that diagram. The first one is other information. We know that earnings affects returns and spreads and maps into these equity market consequences. But there's also other financial information besides earnings. There's non-financial information. There are huge literatures on how the financial information, or why the financial information is revealed. Was it mandatory versus voluntary? Was it some costly signal, or was it just a disclosure, some sort of cheap talk? What about the medium by which information is revealed to investors? There's the entire literature on information intermediaries, and all of those literatures are related to how information gets into returns and spreads, or other dimensions of equity prices. And I'm not simply suggesting here that we broaden our definition of earnings quality to be information quality and then expand our network and we're done. The point I'd like to make is that we can't really understand earnings quality, which is only one piece of information that investors use, unless we understand the role of this other information in the investor's decisions. And this is not something new to any of us. This has been recognized in theory and recognized in empirical studies. There is this other information out there. But there is not, again, enough evidence, in my opinion, on how that information specifically relates to earnings and acts as either a substitute for or a complement to earnings in the entire information set that investors use. Again, there are notable examples, but what you should notice about these examples is that they typically only look at one or two substitutes for or complements to earnings at a time, such as analyst forecasts and earnings, or voluntary disclosure and earnings, or some costly financial signal, such as dividends and earnings. There isn't more comprehensive analysis of the entire information set. And there really are a relatively small number of papers in this literature looking at this other information relative to earnings compared to what we see in the rest of the network. And again, given the nature of earnings quality, this part of the network becomes relatively more important than the positive evidence about the determinants of quality if we want to ultimately understand the construct. The final part of the network that I think was missing from the original diagram is other consequences of earnings. Obviously, earnings affect things other than equity markets. They affect credit markets, or maybe they don't affect anything at all for some firms. The firm doesn't care. Our earnings quality research. And again, I'm not saying that we need to understand these other consequences and just extend our definition of earnings quality to include users other than equity markets. I think the definition of earnings quality as that characteristic of earnings that's useful to equity markets is fine, but we need to incorporate these other users into our analysis. Observed earnings quality, so the thing that we measure, such as the persistence of the number that's reported on the income statement, is the outcome of the firm's choices about what sort of earnings number to report. They're allowed to report one earnings number on the income statement, which we use to measure our earnings quality construct. And how they choose to report that, we all know, is a function of what the different incentives they have, what kinds of users they have out there, what might be useful to those different kinds of users, and maybe importantly, the ability that they assess that different kinds of users have to reinterpret the earnings number or to substitute for it by using other sources of information. So if a firm believes that they can report some earnings number on their income statement and also supply disclosures or other information or have analyst forecasts that can substitute for that income statement number, and that equity markets can use this substitute information, but that contractual arrangements cannot, they might prefer to report an earnings number that's useful to one set of users rather than, which is different from equity markets, rather than reporting an earnings number that's useful to equity markets. And so using returns then to assess earnings quality by correlating the two of those doesn't consider that the firm may never have intended earnings quality or earnings that it reports to be of quality as we have defined it, which is useful to equity markets. There's a recent paper in the JAE, Christensen, Feltham, and Sabak, about this general idea that increasing the persistent components and reducing the reversible components are generally desirable for valuation but not for contracting. And that firms may in fact choose different kinds of earnings, different kinds of persistence that we observe for different purposes if their intent is to meet the needs of certain users. So for empirical earnings quality research, the implication is that the number we actually measure, the construct that we use in our papers and that we assert is a measure of earnings quality, is noisy and perhaps even biased measure of the variable that we are trying to measure, which is earnings quality, the usefulness to equity markets. And the number that we really want to measure in our studies in tests of theories of earnings quality is the earnings number that equity holders use in their decisions. If they unwind the earnings number that we see on the income statement or use substitute information for that earnings number, then using the income statement generated earnings number doesn't provide a measure of earnings quality as we have defined it. So in summary, we're progressing sort of down the natural paths that even in 1955 were established for research on latent variables. When the research is in its early stages, I would assert that we have too much positive evidence in a relative sense. And research on the determinants of earnings quality, although there's still lots of opportunities for new settings to provide more evidence about earnings quality and the determinants of it. But in a relative sense, we have too little research on the path between the fundamentals and returns via earnings. We have too little research on the consequences of information risk, and we haven't really exploited some of the new models and new data. We have too little research on other information sources and on other users. But actually, we're not in the early stages of this research. We've been going at this. We didn't call it earnings quality research since 1968. We've been looking at the association between earnings and returns since then. And we still don't have much rigorous analysis of the individual pieces of research that we've collected over those 40 years with the goal of developing construct validity. And one final point that I want to make is that I've, maybe in too extreme a sense, differentiated the research that establishes the paths between earnings quality and the determinants and consequences from these construct validity type tests. It's really some of the tests that are theory-based tests that look at the determinants or consequences of quality could have a different introduction written to them and be considered tests of construct validity. But in no case was I able to find any specific tests that try to actually understand and aggregate these theory-based tests, whether they called them theory-based tests or construct validity tests, so that we can understand the concept of earnings quality as a whole. That's it.